Hi, I'm Ed Alexander, founder of the Entrepreneurship Law Firm, and this is video 2 of the sources of capital. If you haven't already taken a look at video 1, please go back and look at that. In this video, we're going to start talking about equity financing. Now, equity financing means that you're selling a piece of your company to an investor who will provide you money. Now, this is an important distinction from debt financing. In debt financing, while there is some limitation on what you can do with your business, in equity financing, you have a partner. And you cannot buy that partner out unless that partner agrees to it or you have a contract with that partner that says you can do that. Now, when you bring somebody on as a partner in your business, you're typically going to be a corporation or a limited liability company, and the owner, in the case of a corporation, has certain rights. They have the right to vote for directors and for other matters that come before the shareholders, such as, for example, selling the company. They have the right to receive a share of profits when the share of profits are declared, and they have a right to receive the proceeds that come from a sale of the company. And so basically, you're really taking this person on, marrying them economically, if you like. Now, the most important thing you can take away from an equity investor perspective on this video is that equity cannot be repurchased unless the investor agrees or unless you have a contract right to buy it back from the investor. So if you want to be able to buy an investor out of your company, you need to plan for that ahead of time. Now, most often, investors will not allow you to go and buy them out. Instead, they'll have provisions in there that require you to implement an exit strategy. And we talk about exit strategies in a later video. Now, there are several advantages to equity financing. First, cash flow. You only have to pay your investors when the company is making money and when there's profits to be paid. And even in some instances, you don't have to pay when there's profitability. There is a great ability to grow fast because there's no drain on that cash flow. Everything that comes into the company can be plowed into growing the company. Both of those factors mean that this is a lower risk for the company overall because money doesn't have to be devoted to paying bad debt. And then usually if you get the right investors, and that's a key important point here, is you always want the right investor, they'll have connections that can help you in growing your business. Now, as with everything in life, there's advantages and disadvantages, and frankly, the investors are also a disadvantage when it comes to equity financing because they'll have input. They'll have suggestions. They'll want to talk to you. If you get the wrong investors, they will take up a whole bunch of your time in answering questions about what's going on in the business. Then, if you're dealing with professional investors, they're going to want controls on management. They're going to limit your ability to do certain things in the business, even though they're getting a minority stake. And then, of course, as everyone knows, there's dilution. You're splitting the profits and splitting the sale price. Now, the counter to dilution, and to remember is very important, is that with the money that you're getting from equity investment, you should be able to grow the company a lot faster than you would on your own. So in theory, although you're getting a smaller amount of the company, you should be getting a much greater overall amount because the company is much, much larger. Thanks for watching. Our next video will be about the process to raise growth capital.